So we've covered horizontal support and resistance levels. We know that if we're drawing a support, the market's above it and it's holding the market up. If we're drawing resistance, the market's below it and it's kind of banging its head against it. We talked about the diagonal ability of drawing trend lines. We've got an uptrend line here, and if we draw a downtrend line, we've got a downtrend line here. And then we went a little bit deeper and just put it in channels, which was, I like to kind of frame it a little bit better, and went even deeper and put our midpoint there. And I like to use that as a target for the trade. So let's look out at something now, some higher time frame stuff. So we've got here an hourly chart on the foot. So you know what? Let's mix it up a bit. Let's go crazy and let's go with something like US dollar JPY. Where are you, sir? I think you're at the top. There you go. Thank you. So now we can see what's going on with the US dollar yen. Look at this. We've got an obvious uptrend here, but if again we cannot draw it too accurately, it kind of goes like this, doesn't it? It's drawing around and it curves up, so we can't start drawing that, but we can maybe draw ourselves a little uptrend line here. We can maybe draw, we can go back and say, well, actually we've got a little bit of support here, which is good. We've got a little bit of resistance here as well. It looks like it's what's held us back, because that was the last high back in that time period there, and we're struggling a little bit with it here. So we will perhaps see how that evolves and how that actually develops as we push on. So let's look at a lower time frame chart. That's what I wanted to do with this video. If we're going to a 1 minute chart, and what we're going to get in a 1 minute chart is we're going to get a lot of false breaks. We're going to get a lot of times where the market looks like it's going to go somewhere, but really doesn't. And it's going to chop around and it's going to mess around and it's going to be kind of whipsawing you around. We can already sort of visualize straight away that we've got a resistance level here. Early in the morning, it's probably about 10 o'clock Japanese time. So the Japanese are trading this. They are, there's a resistance level there, and then look how it then becomes support. We break through, comes back and retests. Now, one thing before we move on, I want to mention about buying breakouts. As we noticed in some of the examples that we see, and notice I didn't really cherry pick them. Okay, yes, I did scroll back and try and find something, but I didn't go back miles and miles. We're only talking a week's worth just to kind of elaborate the point. But if we have a resistance level here and we break out of it, very often we are going to come back and retest it, especially if it's not an urgent breakout scenario. So you've got to be very careful that you're not chasing the market, buying aggressively at this high, and then getting caught out as the market comes down to retest it. Because what you can do is, if you're doing that and you're putting a limit order in here, you kind of end up using the same risk. You can have your stop here, but it prevents you from having to have a wide stop. Because really you don't want to have a stop, do you, right on the support level, because the point of a support is that that's holding it. You need to have your stop level under the support, and I don't recommend having it too close under it. So you've got to have a little bit of width in between your position and your stop loss point. So why not try and finesse the trade a little bit better and get involved right at the support? So you've got three phases. The first phase is evidence that the thing is resistance, which we've got here. So we've happily drawn that on during the day and said, okay, that's daily intraday resistance. We've broken through. That's phase 2. So we've seen the break. Okay, fine. Now we want to see if it becomes support. So phase 3 is for us to say, okay, we're prepared to risk this amount here, which is X. Why do we need to risk 2X when we can basically put our order in here and assume that support's going to hold? If it doesn't, we get stopped out there. But we get much more bites of the cherry, and we can hold a bigger position size because our risk is less. Now, the downside of that, of course, as you can probably imagine, is that we are going to miss some of the big breakouts. If there's a breakout that comes and just goes without us, doesn't pull back, then we're going to miss it. And here's an example here, just as we're scrolling back, we can see, we've got a support level here. Let's remove this one. We've got our support level here. The market's come down. It's tagged it multiple times. 1, 2, 3, 4, 5. I would call that a fifth. We've come down and broken straight through it. Now, if you're sitting there with a limit order, you're going to miss this trade. So, trading is not a game of perfect. There's no way that we can catch everything. However, what it does do, and my sort of premise with trading is very, very simple. It's, I want to make the most amount of money possible with the least amount of risk. So I'm ultimately looking to reduce my risk. And if that means letting trades go without me, then that's fair enough. But what you do not want to do is be chasing it. It then comes back. You're sitting on this loss. It's come back here. Now you can't rightfully close that. There's no logic to closing that, because ultimately the premise of the trade is that support is going to turn into resistance. It's going to hold the market. So for any point from here to here, it's kind of a no man's land trade. It makes no sense to close a position. So you've got to have a stop above it. You don't want it very tight, because as we just talked about earlier, support and resistance zones are fuzzy. In other words, it breaks through by a few ticks quite often before rolling back. So you don't want to have it too tight. So you need to give yourself a bit of room. So if you're giving it too much room, you end up sort of ruining your risk reward ratio. You've got a sort of 30-40 tick stop, and your target may only be 50 ticks, so it kind of defeats the object of getting involved in it. So being very cautious. And the other thing as well is that these false breaks happen a lot. They do happen a lot. And here's a great example here. Now what have we got here? We've rotated this out. In fact, this is probably a better one. Let's bring this down. So let's say, for example, we are here and we've said, okay, we've got a high from the prior day, looks pretty good. In fact, we can go back to even far as here. I'm zooming in a little bit. 1 minute might be a little bit not quite enough. Let's move to a 3 and see where we are, see if it'll load up for us. Here we go, absolutely perfect. This is what we talk about with time frames as well, getting ourselves on board with time frames. So we've got a high back over here, and then we've got another high here. So quite rightfully, we can put that as a resistance level. We've drawn it on the chart fine. Here we've broken through by a few ticks. Probably not enough. If we're using a fuzzy zone, that's probably not clear enough for us to get long, but this one may well be, right? We may be looking at that and thinking that's a genuine break. Now the danger we've got is if we're buying that here, we're going to struggle, because our stop is going to have to be here and we're going to get pinged out. Now the beauty is, if we're waiting for the pullback to support, our stop can be a little bit wider. Now this may be a little bit wide, and I've obviously just picked this by eyeballing it, but our stop may well be underneath the kind of fake out area. We may still be able to participate, but if it's not and we do get stopped out, it's much better to take that kind of stop. Listen, because fake outs and breakouts go hand in hand. One day you're going to get a breakout, the other day you're going to get a fake out. So all we can do as traders is limit the risk of getting caught on a fake out. If we are buying the breakout, we believe it's going to break the support, it's going to break the resistance, that's fine. It's a valid strategy. Those are parameters we can do and look at to make that work better for us, but ultimately we still want to be able to control that risk. If we can halve the risk on the total number of breakout trades, we're in a much more powerful position. It means we can ultimately take twice as many losses and still be in the same position. So it's something that people tend to overlook and forget, is that framing the trade and reducing the risk on the trade, not necessarily by always dialing down the position, or I'd always recommend going in with a smaller position as possible, but finding the sweet spot for the trade. It's not enough as a trader to call direction. You can't just say the market is going higher. You have to find a point where you come out of your trade. If you're wrong, you'll stop loss, and you have to find an entry point. And if you can bring those two as narrow as possible while still remaining the parameters of trade, you give yourself a much better chance of success.